Sorry about that. I'm not sure what's happening. That was a strange thing. All right. Well, you saw my disclosures. I apologize for that. And let's go ahead and get started. This is my this is a rundown. You know how to go to tradestation.com, go to research on the top, go to insights, go to the blog, look for the Wall Street sign. All right, really quickly before we get started, I want to just make a little chart here. And I wanted to do a little study here called IV all options, apply volatility all options, add that on there. And I'll tell you, there's something interesting that happens when the VIX goes down is that, calls get less expensive. And it becomes, different kinds of option strategies potentially make more sense as options get less expensive. And I want to show that we're going to turn to this later. First, I want to just quickly go through some of the key points I have here. First, I want to just show you something that's kind of interesting. Let's actually just take a look at the S&P really quickly. I'm going to just do a quick little weekly chart here. Let's go to make this a weekly chart. If you look at this, we are here setting up we are basically, if the S&P goes up, well, now it's about 20 points, but if we go 10 points above, basically, well, 2 points above our high for today, the market just took a little dive right as I was starting. The key point is we are close to a bullish outside week. And what's interesting is if you look on the daily chart here, is that we basically took a dive in this pullback here, and we came back pretty quickly from it. So if you actually look on the chart that I have here, we came about 3 points, from the, from the high of last August, and we basically bounced there. So in many ways, this price action we're seeing here is potentially kind of denying the significance of this pullback. But we had to see kind of how it closes. The end of the quarter, I think the thing that's most interesting here in some ways is that we got above that old high. We've held it, and we're at this point, it's kind of interesting to see where we are in the candle. If you look again on the weekly sort of chart here, this market you can say has been running a long time. You could say it's tired or something, but in some ways, when you really look at it, there's no confirmation of anything really bearish happening yet. And it's one of these things when, in some ways, this is when people say the trend is your friend, and and it's it can sometimes be kind of harrowing to stay with things when they're working. It can be sometimes the hardest thing. I know for me personally, it's often the hardest thing. There's this weird psychological thing when we just want to stick with losers and we want to sell winners. I mean, I think everyone faces it. Mark Douglas talks about it a lot in some of his great work. But I wanted to just point this out because there's really nothing here that's giving us a bearish signal. If you look here, we have our the crossover strategy that is based on the moving average, on the number of companies above and below the moving averages. And what you can see here is this went long based on this strategy back here at the end of May. It has remained long. It came close to getting a bearish signal there, but it didn't happen. So this is another thing that points in that direction. If you look at it, I was just doing a little bit of other calculations, and I saw that, right now we're about 10% above the 200-day moving average. And back in late 2020, it was around 18%. We've definitely expanded upward, but it's not something that is outside of the normal realm of possibility. We're about 6% above the 50-day moving average, and last summer it was 8 or 9%. So you look at it, it's not totally one way or another. I have a series of charts here I use when I make my the actual charts in the blog. But if you look at this here, this is coming back to it went to an over bought condition, and now it has come back down from that. So actually, what I just quickly just realized that when I had my sound off, I wanted to quickly zip back through my disclosures. I'm not sure you guys might have missed that, but if you look, I'm gonna just put this up on my screen really quickly. Now, make a few other points that I thought was kind of interesting. Is that RSI going through an overbought condition has pulled back. And if you look back at other times, like we've worked with the kind of model that in some ways this environment does resemble, the mid 90s we've talked about a lot. And in that environment, the S&P went to RSI overbought many times, and it pulled back a little, and then it went back to overbought, and it never went, to any kind of oversold condition. It never pulled back significantly in that period. So I think that it's interesting just to kind of see that I'm using that as a model, the 94-95 period, because in my view, there are so many similarities to it. So if we go into our breadth workspace, this is MT breadth. Now, most of you guys, I'm pretty sure you have these workspaces. I haven't changed them. So the RSP is the equal weighted index. And what's interesting is if you look in the last month now, RSP is actually outperforming SPY. Now, so this is, SPY is like Apple and Microsoft, and that's like, those are the market cap weighted is the main index. So the big companies are bigger, but if you go to RSP, they're not exactly equal weighted, but a smaller company, like I don't know, like just some kind of smaller companies is going to be similar to McDonald's, to Apple and to Microsoft. So the key point is that as the breadth improves and as participation widens, if that does happen, you're going to see RSP outperform SPY. Now, for most of the year, we have seen SPY outperform RSP. You can see on a 6-month trailing basis, a year-to-date basis, which this is, SPY is outperformed here, 14% versus 4.5%. But if you look in the last, month, the last 21 trading sessions, or the last 10 trading sessions, RSP is outperforming. This is exactly what people said was going to happen. There have been people wanting this to happen. This has been one of the most sort of discussed sort of things. It's out there and it's starting to happen now. So I think it's kind of important, but it's also interesting to realize that in some ways, this also argues against holding the mega caps like the Apples, the Microsofts, the Teslas, the Amazons. It argues in favor of looking into other areas, and we're going to be talking about some of those. But I wanted to point out that this is very much what people were talking about, that this could happen. Also, if we look at our account, very quickly, if you guys don't know the breadth workspace, let me just quickly show you how this is set up. This has multiple charts. I recommend that you do not mess with this and then save it. I mean, I set it up a certain way. I have not saved this since I first set it up. The reason is because it has some scaling and stuff that if you change it, it could like cause the charts to not line up correctly. So this is SPY here against RSP, and this shows that when negative readings mean that you have stronger breadth, the large caps underperforming. So we want to, on this, if you want to see positive breadth, you want to see a negative reading on the relative strength. Now, this is not RSI. This is relative strength that compares simple price performance of one index against another. And you can see here that this was the mega cap. This was when Apple and the tech stocks were leading. You could see that SPY outperformed the equal weighted. But here the equal weight is starting to show some outperformance in the last month or so, like I said. And this is what you'd be looking for. You can see it on the radar screen, and you can see it on this chart here. It's also interesting that if you look at RSP has not gone back. There's a white line on this chart. It has not gone back to its highs yet. It's this is its left. It's on the left axis. So and the S&P is above its high from, for example, last summer. You can see here that the bars, the candlesticks are above their high from last summer. See, this price action is above this spot here. But if you look at RSP, this is where it was last summer, and this is where it is now. So if people are looking for equal weight to play catch up, those are some of the points of reference to look at. Now, this chart has the advanced decline line on it. It also has the same thing as the crossover strategy workspace. And we can see here the blue and red lines. But what I wanted to point out here is that we're continuing to see new highs getting hit. And we're going to take a look at some of those. In fact, if you go to your MT main workspace and you go to your price grid, you can look at distance from 52-week high. All right, and you can just sort on that. And then, wait a second. All right. Let's just go like this, click on it, sort on that. Where are the zip files? All right. Someone's asking the zip files. If you go to here, they're in the top of this blog post. Okay. So the crossover strategy is in this zip file. And this is actually what the zip file looks like. Let me just show you. This is it has the MT3 data X over strategy. Now make sure you load the ELDs because this has a custom strategy, not an indicator, a custom strategy that actually does these. This multi-data cross LE is the custom strategy. It's in one of the ELD files. Just so you know that we'll show this to you. So I wanted to, that's how it works, this thing. All right, let me just, sorry, I have too many things happening here. So remember, just go to the blog post and everything will be in there that we want to show you. Let me go back here to my MT main. Okay. Sort by distance from 52-week high and just go down here and look for everything that's under 0. So this is basically an indicator I created. It's incredibly simple. They just go to data's add label row. Okay. So these stocks, I can also go here to settings page, add reference rows. And let's actually see now. You can see, what do we have? 55 companies in the S&P 500 hitting a 52-week high today. If you look over on MT breadth, it says 40, but that's the number at this moment. So anyway, what's interesting, that number sounds slightly, it might have a rounding error, but anyway, close enough. The key thing is, these are some of the companies we're starting to see hit 52-week highs now. And what's interesting is, if you look at them, we can also go here to studies, add study, market cap. And it's interesting, I think, to actually see that we're seeing more small companies starting to hit those highs. Let's just add that. All right, so market cap, if you look at the companies making new 52-week highs, say you got Apple, you got Visa, which I actually wanted to point out. Visa popped up on a bunch of it's not, all right, so here's the thing. This thing is doing a rounding error, but it's close. I had it set up to round, it's probably rounding something up slightly. But the key thing is that this is showing a broader sort of participation as you look down the list to more of these kind of smaller companies are stepping up as it widens out. And that's really what, what I wanted to show with this. And the way you do that is, remember, just with MT main, it'll show you the, the distance from 52-week high indicator, which is the one that we can work with here. If I actually go to studies, edit, if I go to style, I think I can actually see that I probably set it to round. See, it was rounding these up to 0. So I apologize for that. What this does is it takes the high of the day and it divides it by the 52-week high. So if it hits a 52-week high and pulls back, like I guess Vertex did, right? It will, it'll give you, reading when it could be under the 52-week high at the time. But I like to just kind of see that because it allows me to quickly see, let's see the stocks that made 52-week highs today. I like to kind of look at that list, stay familiar with it. All right. So I want you to take a look now at some of the news as we work down the list. I want another point here as we look here very quickly. As like I was saying, more companies under 100 million market cap are making new highs. And then what's also interesting here is if we look over here on key ETFs of MT main, and we look at, do I have DJT? I have risk on cyclical. I don't have it on here because, I think I did not include this because not everyone has access to the Dow Jones Transports. But what's interesting here is the Dow Jones Transports has been really coming to life. And this is kind of giving a degree of sort of Dow theory confirmation to the recent strength. And I wanted to kind of point that out that The Dow theory in some ways was, it wasn't confirming the strength earlier in the year, but the move that we've seen, especially this month, has kind of confirmed this idea that we don't have a big sort of economic recession coming. At least that's the typical sort of thing. As we got the economic data today, it confirmed that. All right, the last thing I want to just point out from the chart is the high from April 21st of last year on the S&P 500 remains a level that I'm kind of, pretty cognizant of. This was an ugly reversal right here, this high, but I'm watching that. To me, that's a resistance line that we might want to just keep in mind. So like I said, I want to just stay focused on the fact that on the weekly chart here, there's just nothing that is giving us, there's nothing that's particularly bearish here. What's interesting is, if anything, if you look at another week, like for example, this week back here in May, we tried to break lower and then we ended up with a bullish outside week, and then we had continuation to the upside. What this week, will it be the same? Will it be a break lower and then we get, basically the bears get rejected? That seems to be the sort of case. And remember, the basic technical point that I've been making is that if you look back to like 1995, or if you look at a period when something goes sideways for an extended period of time, historically, and you typically do not get a pullback for a while, because there are not entrenched buyers or entrenched longs who are sitting on big gains who are going to become, sellers, going to go into distribution. A period like this is usually followed by a relatively steady move, and that can be true to the downside as well when things break. And they, like, if you look back at some of the big tech names when they broke in late 2021, it was a straight line down. I mean, if you look at something like PayPal, when it broke, I mean, it was just unrelenting downtrend. This was a period of sideways. This was when, basically there was a distribution, something called like a distribution top or something. But the key thing is it was a period that went from bullish to neutral to bearish. And the thing now is that if we've gone from a period of bearish to neutral to bullish, then you have that same thing. But the key point is that when you escape from that period of sideways movement, pullbacks can be limited. That is historically the way trends play out. Okay, let's take a look at some of the news. It's pretty interesting. I just want to point out that, well, Carnival was an interesting one. We've been talking about Carnival all month. We had over here on TradingView, we have been talking about the upside and the cyclical sort of names here. We had this thing on Carnival here back on June 5th. If you don't have our link to TradingView, I should probably start including that going forward in the blog post. But this is our ideas on TradingViews. And there's a question of whether this is being recorded. It will be. And you know what, sir, if you have any questions, just email me at drussell@tradestation.com. If you have any specific questions about using this. But anyway, these ideas on TradingView, we talked about this thing with Carnival, and then they came out with this, pretty significant breakout. But they had strong earnings, and now the stock at this point is kind of like, this trade, is, who knows exactly where it kind of stands now. It had this, the earnings came out, they sold the news, and then there was a huge swing of buying in it. I don't really know at this point. Look at this implied volatility, how it ran up before earnings and then plunged. So, but anyway, it's interesting to see what had happened in Carnival. That was one. And we also wrote about, there was a vertical call spread that somebody did. They were looking for a move from the 16 strike up to the 20. So these guys are looking for the move to continue over the summer. We wrote about this earlier in the week. That was kind of interesting, a bullish call spread. All right, now this week, I mean, honestly, I'm looking at this economic data, and like, this is exactly what we've been talking about. We've been basically saying that there are like multiple positive things happening here. The American economy, people don't look enough at the big long-term picture. We had globalization suck jobs out of the economy for decades. And I'm not saying that judgmentally, it's just simple like math. Other things did well, between the period of 1998 and 2016, a lot of other areas did well. But since 2016, we've seen improvement in the job market, and it only continues to get better. As we look at the economic data that continues to happen here, what we see is we continue to see this massive reinvestment in the American economy that was that went away during the period of globalization. So when you look at the GDP numbers today, I mean, it is incredible. I mean, it's just incredible to see. They revised up the GDP significantly for Q1. They revised down inflation. And then you see also consumer confidence went to a 17-month high. You see jobless claims, went back below expectations. So everything here continues to point in a direction of what people really could view as a Goldilocks scenario. I'm not going to get into it now, but we've talked about this massive reconstruction of American factories that nobody else is talking about, but it's in the commerce construction data. The key thing is this bodes well for the next 5 to 10 years of income growth, GDP growth, and people who are missing this. And I think most economists are not looking at this. They have a model, but the model is based on something that was true over the years, and they're not reacting to the fact that jobs are coming back to the United States. The economy is shifting from being consumer dependent to being enterprise based. And this is something that is just continuing to manifest in the data. The pending home sales today were lower than expected because we have a shortage of houses. And that is overall, again, another positive for GDP because we don't have enough houses and they need to build it more. It's essentially a fact of disinvestment in the American economy that was first because of globalization and secondly because of the housing crunch. Those two things, people stopped investing in factories in the first decade of this century. They stopped investing in houses in the second decade of the century. And now both of those investments are coming back. And that is driving GDP, and it's going to drive incomes. And at the same time, inflation is coming down. So, I mean, this is a positive environment. And in some ways, this is probably similar to some of the things we saw in the 90s as well. Next week, we're going to start to get the PMI data, the ISM, and these guys have been showing, declines in factory activity and pricing and inflationary pressures. And what's going to be interesting to see is right now there's a lot of slack has occurred in the factory sector, despite them building new factories and stuff. So what could be interesting to see is if we start to see an uptick in some of that manufacturing and stuff, supply chains have been fixed. And this is all the data. If you look at the S&P global PMI data, if you look at the Institute for Supply Management report on manufacturing, what's happened now is supply chains have gotten back in order, and now we can see production ramp back up without inflationary pressures. Unlike 18 months ago, back then we ramped up and this is inflation because there were bottlenecks. Now it's set to ramp up without inflation. This is all in the data, and I can't get into it, but just Google those things and you'll see. All right. What's also really interesting here, and I don't have it in front of me, but I got actually got my feeds here, my crude oil. So look at the SPR. I mean, this is like incredible, and I don't really know what to make of it. There's a part of me, I keep looking at this thing, and last week I didn't. I'll just show you now. This is what I wanted to show you. This is basically crude oil chart. And, I'm just watching and waiting here because, a lot of the forces, when you look at the, as people focus on this cyclical strength in the economy, and they, it gets easier to look at things like energy with some degree of confidence. So at this point, I think it's interesting because if we look at crude oil here, I mean, it's just kind of sitting in this range, and if you look, I have this line coming down and it's basing out at this level from back in 2021. So for me, I mean, there's not a lot of clear signals here, but the macro environment is getting to the point where it's hard to argue that oil needs to go lower. And I think the thing is, there were a lot of people that got bulled up on it, and then they got their hopes dashed, and the Russians just flooded the world with oil, and OPEC is clueless about right now how to handle this situation. But there is also the point here where people are focusing back on the cyclicals. If we look at MT Main and we see the actual kind of mix of the sectors that are performing well, look in this month, we see things like metals, industrials, small caps surging. I also want to point out that we're starting to see the IWD, the value is starting to outperform growth, which is like pretty interesting. So those things are going to start to make it so that people can accept the idea of owning energy. And I think that they've had their hopes dashed so many times, thinking energy is going to rally. It's like Lucy with the football. But at the same time, the pieces are coming together for that. So I wanted to point out, or they're potentially coming together. As we look here on the data, we today saw that the SPR is at the lowest level since U2 was playing at Red Rocks in 1982. You're basically seeing today it was yesterday, the crude oil inventories were a much bigger draw than expected. So I'm not saying that right now the oil it hasn't given us the signals, but I think it needs to be on our list, especially as we move to a new quarter. You can start to see a degree of people rotating to new things, and it's starting to make more sense potentially philosophically when you consider the this idea that we are in a strong economic environment. It was interesting also with Micron. They had good earnings, and the stock fell. And I think this highlights, and we've talked about this a lot, well, not a lot, but we have mentioned it a few times, is that semiconductors actually don't have the greatest backdrop right now. I can't remember, the guy at Citi, I think, there were multiple people that the SIA, the Semiconductor Industry Association, if you look on their website and you look at some of the blog posts, they're forecasting that the semiconductor business is going to actually shrink in the next 6 to 12 months. Now, China weakness is part of that, and whatever else there is. But the key thing is that the semiconductor fundamentals don't look that terrific right now. Micron is just an interesting one because it's kind of it's as close to a kind of commodity in the space as you can get. This sort of weakness is actually, I think, showing you something that's kind of interesting. The other thing is, if you go to our MP sectors and you go to SMH, you can see here that the semiconductor index versus the S&P 500 is pretty much the highest ratio it's really ever been, or at least in the last 20 years. So this is the ratio of SMH against SPY, and it's essentially just showing the semiconductors relative to the S&P are I don't want to say overvalued or expensive, but they are at a high historical ratio, and that's something that some people have been pointing out. And I think that as we get to a new quarter, that could be something that is a concern for some people, especially when you consider the fact that yesterday we had the bank stress test being positive, and now we're starting to see strength, like I said, in the cyclicals. And who leads off earnings season? It's the financials. Who's rallying today? It's the financials. So I think that's kind of an interesting thing to think about. Financials took a beating back in March. This is the XLF, this was the whole financial, so the banking crisis. And if you look at it now, it's a very tight range. And if people are looking, toward things that maybe have a value opportunity, if they're looking toward, areas that are going to be opportunities later in the year, this is an area where people might look. It's also interesting if you look at the XLF historically, this level, if you actually look at this on a long-term chart, actually look over here, maybe MT sectors at XLF. This level around between around $30 is very historical. This level was the level that was the high before COVID, and it was also the high in 2007, pretty much right there. We've been holding it pretty much since we hit it last July, and then we revisited it when Silicon Valley Bank failed. This is the weekly chart. But when you look at this long term, people look at this here, they could be viewing this as something where it has that sort of potential. So I want to just kind of point out that, we often see rotations when new quarters begin, financials kick off earnings season, and we're seeing the shift towards cyclicals here. So that's on my radar. Wait a second. I think I gave you guys. I apologize. I wanted to actually share. I think I posted it to the wrong thing on. This is my trade. These are my trading view ideas, and let me give you my email. I sent it to the wrong thing. If you look in the Zoom chat. Somebody did have a question. Feel free to email me. All right. So let's take a look here at, we do our mover of the week. So last week we talked about the non-index runners. It was a scan we set up to find these sort of new companies as breadth, widens. How do you find companies that are maybe the stocks you don't look at? So this was a description of how to do this with Scanner. This week we're looking at Zillow, which, people have probably heard of more than YPF, which is the Argentine fracking company. But what's interesting here is we've seen this real spreading awareness. If you looked at the ITV, the home builders, for example, there's been this spreading awareness of what's happening, with the housing sector. We've been talking about it a lot, and now I think a lot of other people are catching wind of it. It's interesting. The ITB, I think, actually broke out to a new all-time high, or at least a long-term high, with this last big candle. So that's kind of interesting. Zillow, there are these derivative plays in real estate. It's not a home builder, but we all know what Zillow is, I think. Housing sort of thing. And what's interesting about this also is there's some other companies, EXPI, and the other one is, what was it? I'm sorry. These are kind of related, Redfin. So as the boom widens, as housing does well, and as the awareness of it widens and people start looking beyond just the home builders, these are some of the other names that were kind of popping up that I had wanted to mention. And Zillow is part of that. So it's interesting to see this broke out to a new 52-week high, but it's still down a lot. And here we have it coming back down to the 8-day exponential moving average. This is kind of interesting to me here. I think that this is a name that might start to get on people's radar. And I think if you actually look back at it, their last quarterly report was actually stronger than expected. So this is still an interesting name. Is down pretty far from its highs, a year and a half ago. So this is the mover of the week I want to highlight. So as we look out, tomorrow we have inflation. We have ISM manufacturing on Monday. That's the reason I was talking about this ISM thing, the PMI. That, I'm telling you, that is, in my opinion, the single most important inflation number, not because the market reacts to it, but it's the number that matters. The price index subcomponent of ISM was the leading indicator of inflation back in like early 21, even late 20, I think. The inflation thing surging. We saw it in the ISM manufacturing price index first, and it's been negative now for months. So that number is interesting to watch on Monday. The market's not going to react to it, but what will be interesting to see is, do we actually see the top line number of ISM, the overall number of activity increase? We've seen a lot of weakness recently in orders and production and shipments, but that's been in many ways a quote good thing because it shows slowing of the economy. It also shows that as the production slows and orders slow, production has caught up with demand. So it's no longer running at this breakneck pace. Things are back to a normalcy. And I've said this before, I do believe that in many ways, this year is the year of returning to normal. After COVID, after inflation, after all this other craziness that we've lived through for the last 3.5 years. And so what's interesting is I just want to point out, I think with the economic data, inflation coming down, it's again a return to normal. All right. Oops, I misspelled that. Market is closed 4th of July. Hope you guys have a good Independence Day. There's the OPEC meeting on Wednesday. So what's interesting about this is, you know, the fundamental scenario in oil with the, you know, the economy strong and the inventories coming down. This chart that I'm showing you, like I said, I'm not trying to make a call on oil or anything like that. But to me, it's just, it's kind of on the watch list. And if it starts to break out and run, you know, I think that the, you know, the reaction to it might not be to fade it. It might be, oh my God, it's now moving. And I was behind, you know, we missed, you know, you could see suddenly the reaction to it would be, wow, maybe oil's not dead after all. So I want to just point out that that's a big thing next week, you know, with OPEC, this chart on oil, the new quarter, the economic data, the tight inventories. You can see the pieces coming together, but we don't have the technical confirmation yet. All right, so now I want to mention this idea of leverage cyclicals, because this is really what the market has seen in the month of June. The top gainer this month has been, well, maybe not exactly, it was Carnival. I'm not sure if it still is, but if we look at the S&P 500, if we go to our price grid here, let's just sort on 21D. Carnival. Now this is this is almost exactly a month. It's 21 calendar days. Carnival, Norwegian, Delta Airlines, American Airlines. Wow, can you believe Grainger? This name is just one of these incredible industrials that nobody talks about. But I mean, this is an industrial supply company. In other words, it's like Fastenal, which is better known. Now, again, if we were in a recession, I don't think this stock would be hitting a new all-time high today. You know, look at the price gaps in this thing on earnings. It's had these just repeated gaps up. But anyway, the main thing here I want to show is, you know, why are these stocks the #1 performers this month? And the reason, and we've been talking about it, leverage cyclicals. Well, actually, you know, that I put I put this divider in. That's why it. Anyway, with leverage cyclicals, the key thing we have to think about. All right, so say you have, you know, let's just really simple example. You have a house that you rent out. The monthly mortgage payments are $1,000 a month. You know, when times are you know, normal times, you know, you rent it out for $1,100, you make $100 profit. Then times get bad, it goes down to $950, and now you're losing $50 a month. But then times get good, and now you're renting it out for $1,200, $1,300, and you're making $200 or $300. You can see from a 10 to 15 to 20% swing in your top line, your bottom line can swing by 100, 200%. The reason is because your interest expense is fixed. Well, it's the same way with the cruise ships and with you know, the airlines. They have a lot of debt because their assets are expensive, and so they borrow money to finance them. And then you know, as their business gets better from an expansionary environment, like you would see in an improving economic environment, you know, airline travel, cruise ships, those things do better. Their top line gets better. And then as a result, you know, for some of these guys, their interest expenses, like it can be like half the size of net income or something. So then the thing is that as the overall profit gets bigger, it can create significant leverage. But on top of that, there's some other things that can happen, is that the pricing gets better as demand improves. Now, these guys have not been building new cruise ships. They have not been adding to inventory. So at the beginning of this upcycle, they have pricing power. So we have identified 7 catalysts of movement in stock prices. And #1 is volumes. #2 is margins. And we've written articles about this, outlining the 7 different catalysts of stock movement. And it's part of a series here as we talk about. But the key thing is that they are seeing margin expansion because pricing is doing well and there's not a lot of supply. They can name their price for a cruise. They don't have to cut costs. So that means their EBITDA and their profit is getting bigger and bigger. Their income is staying the same. But then on top of that, there is another little kicker. You know, with this house example I have, you know, your interest expense is fixed. But what happens if the Fed is near the end of the hiking cycle? What happens if the Fed cuts rates next year or the year after? Well, then guess what? These guys have bank loans and they have other things that are pegged to short-term interest rates. So then you actually have the potential for their top line to improve, their margins to widen, and then their interest expense can actually come down. So that's what the market is looking at and seeing. And they're seeing these companies that are bona fide real companies that have been hammered by the pandemic environment, and now they're coming back from the dead. So that's why we're seeing it. And I believe that this is something that is kind of spreading throughout the market. The other thing I want to just mention is, we have this other catalyst of credit. You can read this if you want, but the key thing is that when people, when you're headed toward a recession, or the market thinks there's a recession coming, your cyclical stocks, people will assume that they're going to suffer. And then when the recession doesn't happen, they come surging back. And that's what we're seeing here. So I wanted to just kind of highlight this as a process. Now you can find this using the platform with our enterprise value to market cap custom indicator. But first I want to zip through some stuff with some options. I want to just show you. Before I do that, though, let me just mention that I think it's interesting to actually look at consumer staples. Companies like General Mills and some of these companies, in my view, these companies in many ways are going through the opposite process, where they have a fair bit of debt. The reason is, well, because people will always buy Wheaties or whatever, and that's true until it isn't. And the problem is that a lot of these consumer staple stocks, Newell Brands is another one. I mean, Procter and Gamble, a lot of these companies, they always have assumed that they are going to have certain market share. They're going to have certain ability to have margins and control pricing. And then as that fundamental story disintegrates, their business becomes very problematic because they have a lot of debt. And that debt is a fixed cost that then, as their EBITDA starts to struggle, it goes in the opposite direction. So when a consumer staple stock goes bad, there can be a very steady downtrend in them. And a lot of these companies have very low implied volatility. And if people start to look to the downside, this could be something we start to see. So let's talk now about options, because if we look at something, the one that was standing out to me off the bat was Wells Fargo. I want to just point this out because, I mentioned the thing, first of all, consumer with these leveraged cyclicals. And well, the banks they're not the same as a cruise ship, but in some ways, if you think about them, they're not that different. They're cyclical, they're leveraged, and they trade at low book value. And these are companies that, as we emerge from recession fear to, Goldilocks, which it looks like we're getting, these are stocks that now suddenly people will start to look and say, you know what, they're going to look better 3 to 5 to 6 to 8 to 12 months out. And you can start to see, so from my perspective here, if you want to just look purely at technicals, and you look at the macro backdrop, something like Wells Fargo does not look that different than Carnival did, 3 to 6 months ago. And so I think, the market is going to start to see that. And if you look at some of the calls here, so let's take a look at our Option Station Pro. And now this company reports earnings on the 14th of July. So I was looking here at some different, sort of things with options. It's kind of interesting because for people, looking for the, for earnings season, the, you have 2 expirations that would match that. And people just looking for the simple month of July. But, if you look at a, level like around, you have a level here around this 43.5. And, from my perspective, if people are looking for, moves to the upside, there would be, potentially a view that if it breaks through this level, it could expand higher, because that is what happened with these other names. If you look at something like Carnival, when it got above this level, it was, pretty, significant. Also, even when it got above this level, in many ways, that's really when the move started, when it took out this high from like, this point in March. It tried to rally, then Silicon Valley Bank crashed and it got hammered. Right. And then this was like your resistance line. That was the level where people felt the pain, and they came back and they came back to it. Now, what's interesting here is that if we look at something like Wells Fargo, you have, sort of levels, in this case, it's not exactly the same, but I want to just kind of point this out because to make Wells Fargo, JP Morgan, a lot of these stocks have levels here where they are close to old, points. And the thing is with options, the options are, relatively, when you look at the actual pricing, it's not a fortune. A call spread in something like a Wells Fargo, 44 to 46 call spread here. We're looking at 65 cents minus 22 cents. That's a 45-cent call spread that does a $2. That's a potential risk reward of 3 to 1 to the upside of a break, something like that. Something like JP Morgan, you have another level here on a name like JP Morgan. Someone could be looking at like the 145, 150 call spread. Another name that was popping up, I was just noticing as I started this webinar, was Visa. Visa also has a line here. Now, also, we've been starting to see, let's look over here at MT Main. Let's look at key ETFs, and let's actually look, because we're starting to see, if we look at our indexes, we're starting to actually see the Dow is starting to outperform. You can see here the diamonds are up more than the Qs in the last week. So we're starting to actually see the Dow outperform the Qs. And of course, Visa, JP Morgan, these are Dow members. So, if we start to see a rotation to the blue chips, which is actually something that's relatively common when a quarter begins, I've noticed historically, people kind of go back and buy the quality. What would your grandfather buy? You buy JP Morgan, all right? Well, there you go. And in the beginning of a quarter, that is the sort of thing that sometimes happens. So I want to just kind of point out that when we look at, there are certain companies now that have similar sort of patterns that the airlines and the cruise ships had. And they're also, Visa is not exactly a leveraged cyclical, but the financials are, and they've been very tight. And, for people looking for options, opportunities, some of those might be a place they would look. My point, I want to just kind of mention that a lot of things of what we're looking for here is to kind of recognize just different things work in different markets. And in this sort of environment, it appears to be seeing a rotation back to these sort of, cyclical growth names and away from the mega cap tech. And it's not to say it's going to last forever, but it could last for a few weeks. And that's the sort of thing that I'm just kind of trying to focus on. Where is the market kind of going the next few weeks? And the other thing to remember is that the mega cap techs don't really report until that last week of July. So you have the financials first. Now, if you don't know how to find that, let me just quickly show you. If we go over here to, something like our fundamentals page, I'm going to just go to studies, add study, if you don't know how to do this. And then you can go to next earnings date. You should all have this. Next earnings date RS. I'm going to just add that really quickly. Now, this is going to take a minute to load. But you can see on the chart, I have it tell you the next earnings date, but you can also dig in here. This I might not have time to load all of this. So the other thing, though, is that you have names like ExxonMobil. And, if we actually get that thing happening in energy, that might happen. I'm not saying it will, but if it does happen, there's also going to be people potentially looking to some of those big energy names. So if we look here, I think I have it on Price Grid. I don't have it. I'm trying to see where I don't know if I've actually given it. There's an indicator I've given you called average options volume. And you can set it. This is in your workspace, in your ELD, and you can set it to highlight, right? So it will highlight stocks that trade at least 20,000 contracts a day in the trailing, month. You can, if you can change the time frame if you go into. It's taking a second to load, but this is something to me that's kind of interesting. I'm actually working on a scan. I'm going to share with you guys on how to, on how to kind of, scan for those names that are super active on the options. In fact, let me actually get back to this. I wanted I actually have a little tutorial here. It's actually my platform tutorial of this week, which is the enterprise value to market cap as a way of finding leverage companies. So if you look here on fundamentals. This is an indicator that I created, but it's based on, this is the earnings date thing. Let me move this over here. But if we go to EV to market cap, when this is a big number, it means it has more debt. You can Google what enterprise value is, but it's a really good concept. And so you can see here that right off the bat, we have the biggest ones are financials, which is not a surprise because they have all sorts of financing. But if you look down the list, what do you see? You see Caesars Casino, you see American Airlines, you see Citi, you see Ford Motor, you see General Motors, Norwegian Cruise Lines. So these stocks were already popping up on this scanner, on this approach. Now you can do this in Scanner if you basically just follow the steps I show here. You actually have this indicator you can actually run in Scanner. Quick question though, David, what's your opinion that some CEOs admitted during conference calls are using inflation to raise consumer prices? I mean, honestly, I think that story's like 24 months old, to be honest. We actually wrote about that in Q3 or Q4 of 2020 of how companies were taking advantage of pricing pressure to drive earnings growth. And it was an article some time back. So that ship has sailed. And I think that it's no longer really the case. All right, we go to Scanner, which is the flashlight. Let me just quickly show you how to do this. So I'm just gonna just quickly, actually, I already did this. I created a scanner here already. I just started naming my scanners after the day. So this is market trends for today. So basically what I set it up to do is the first thing you do is you put an enterprise, you put in market capitalization, which is under your capitalization folder. You can set that to like 1,000 or something. I always set it as volume, so it is in the volume folder. And then I set to the average volume 10-day greater than 500,000. That prevents me from getting lots of like illiquid stocks. But here we go. It's going to be under, if you go to indicator, this thing, EV value to market cap, you're going to go to this and then just go to indicator and it will pop up under your indicators list. You just hit like EV. I have it right there. You should have it too if you've imported the ELDs that I've given you. And you set it to say greater than 2. And then I like to set sector. You go to sector is also an indicator. It's under there, under one of the indicators. You set it to does not equal this kind of this symbol, this operator, quote, quote. And then I set it to, I want to see stuff that's over the 50-day moving average. So I also bring in, I say last price greater than 50-day moving average. And then I say that it's up less than 10% in the last week. So I actually ran the scan yesterday and it basically gave me things like American Airlines. And so I do now is I sort on this, I'm going to actually go to, let me just make the font bigger. All right. And just quickly show you what it gave me. And I can now sort, this is a 5-day change over here. So it's going to do is it's going to find stocks now that are basically have an enterprise value that's at least twice their market cap. What's interesting is it brought up some of these interesting names that, you know, here's Melco Crown, which is the Chinese gambling company, the casino company. But you can also just sort it by market cap and see that some of the names it brought back that were high on the list. And there you have Ford Motor, you have General Motors, Capital One. Now, the reason we include the sector is because financials will always, will usually pop up. So what I'm looking for in a name like this are going to be your consumer cyclicals or, you know, things like materials. I think utility stocks will often have a high enterprise value to market cap. But as you look down this list, you see American Airlines and some of these. So I'm going to kind of be looking down this list. You see, we mentioned Avis Budget is kind of on that list. We mentioned this up here as being one of the leveraged cyclicals. So these are some of the things I wanted to kind of point out. And I think that the key thing with this is just to kind of recognize the sort of environment we're in, and to see that for the time being, the situation hasn't really shown any kind of real deterioration. And for people who look to follow trends, there's nothing yet to invalidate this uptrend, especially the way that we bounced so close to the to that recent low. I want to also we bounced above the August high. We went 3 points and bounced at it, and then that weekly chart is starting to show that potential. That snapback, that inability to follow through on last week's bearish candle. What's also interesting here is the AAII, sentiment index. We are continuing to kind of see that there's this new kind of cohort of 40% of people are now bullish on stocks. You can see it having kind of improved. And from my perspective here, what we could now see is just a widening of this sort of sense. And the real thing is just the people who have been, religiously bearish for the last 6 to 8 months, every week, a few of them cross over, and a few of those people, they kind of become more bullish. And now we're in that process of being that marginal incremental shift. And I think, just think really quickly, you have with a new product, the iPhone comes out, there's a million, a few diehards stand in line for, 48 hours to buy the first one. But the real growth comes in the following weeks and months when everyone else gets it. So we're at a point now where you have the early adopters of this bull market, who saw some of the patterns we were talking about. They saw this stuff like AI, but the broad mass of people out there yet are just now kind of slowly migrating into the bull camp. And I think that's what we're seeing here. And as that happens, that's the reason why there's just not a lot of selling force in this market. So I actually forgot to even show you. I wanted to point out that we did this chart study on the Russell small caps. You might want to take a look at. That was when they kind of worked out, kind of interestingly, the way but it fits into the exact same narrative. This thing has been a real underperformer for weeks and months, and now as it kinds of starts to play catch up, this chart study that we did yesterday on TradingView might be of interest to you guys. So I've been kind of scattered with this. I mean, there's a lot of different things that are kind of flying around here. And honestly, today's economic numbers, the final revision of GDP is never, I've never seen one that's this interesting. They're normally complete non-events. This one today was a really big one, and it's kind of, just really been interesting to me. But I'll say, even with that strong GDP number today, the Fed tool, the CME, the interest rate expectations going forward have not changed, which means the market is looking out and it's continuing to see that, easing of inflation. So it's great to be with you guys, and I will see you again next week. Feel free to email me at drussell@tradestation.com if you guys have some questions. Have a good one.